Canadians' rental investment landscape is screwed, and I'm going to tell you why. Regulator for the Canadian Bank, the Office of Superintendent for Financial Institutions, OSFI, has finalized significant changes to mortgage regulations that will reshape Canada's rental property investment landscape effective 2026. The most important changes relates to the treatment of mortgages for rental properties. These modifications to lender requirements, well aimed at stabilizing the financial system, will create substantial market consequences that exceed far beyond individual property investment portfolios. What's changing? There are a couple of key changes that are important for rental properties. Higher borrowing costs for rentals. Starting in 2026, banks will be required to classify mortgages as income-producing residential real estate when rental income accounts for more than 50% of the mortgage qualifying income. This classification denotes a higher risk, resulting in higher costs for lenders, who will pass these costs on to borrowers through increased interest rates and stricter terms. The most consequential change prohibits double counting income streams. Under previous rules, it was possible for inventors to count the same personal employment income or existing rental income to support mortgage applications across multiple property purchases. OSFI has eliminated this practice completely, requiring each mortgage to stand independently. OSFI's Director of Capital and Liquidity Standards confirmed income that was used on the first mortgage is removed or corrected when assessing additional properties. So here's the major elephant in the room. While it's clear that these rules apply to mortgages, refinancing mortgages, and mortgages for rental properties, it is not clear if this applies to mortgage renewals. The question everybody should be asking, will these rules apply to mortgage renewals? If this is the case, then all the existing condo rental stock will be subject to higher mortgage rates. If all condo rental owners have to pay an extra 0.5% on their $500,000 mortgage, that's an additional $200 per month. The recent changes could impact 25% of the current market. This timing aligns with a surge in investor involvement in Canadian real estate. Investors currently account for 25 to 30% of all home purchases across the country, making the highest percentage ever recorded. The data indicates that university towns have higher investor ownership, which does provide comfort that the property will be rented so long as supply doesn't outpace the student population. Recent changes to Canadian immigration policies have introduced an intake cap for student visas. The target is set at 437,000 study permits for the years 2025 and 2026, reflecting a 10% reduction from the 2024 target of 485,000. While there is no specific percentage change noted for the years 2020 to 2023, an overall trend increasing international student numbers was observed in the early 2020s, prior to the implementation in the cap in 2024. The new policy aims to reduce the number of temporary residents in Canada to 5% of the population by 2027. If universities are forced to accept more local students, many may choose to commute from their parents' homes rather than rent near campus. The net effect could be negative, highlighting the risks associated with the rental market. This may explain why the regulators have required banks to hold more capital to support rental property mortgages. Fewer buyer investment purchases account for 25 to 30% of all property transactions in Canada, with a higher concentration in university towns and cities like Toronto and Vancouver, where there are significant condominium markets. A substantial increase in borrowing costs with investors, resulting in a decrease in their activity, could lead to significant demand destruction. If the new regulations lead to a cut in investor purchases by half, total market demand could drop by 12 to 15%. This would apply considerable downward pressure on an already weakening market that is experiencing declining sales volumes and price corrections in various regions. This property will hit small portfolio investors, dual property owners, and anybody looking to scale rental income. So I'm going to give you an example to show you exactly how this is going to work. Example 1, how this will work. Meet Noah, a Calgary buyer. Job income $102,000 per year. That is $8,500 per month. Owns his home, his monthly payments are $1,700. He buys a rental condo that rents for $2,400 per month. His lender allows 70% of the income, which is $1,680, to count toward the qualifying income. So his current qualifying math, $8,500 for his salary, $1,680 for the rental is $10,180 per month. At a total of 44% of his total debt to service ratio, he can spend up to $4,479.20 per month on total debts. After subtracting his existing $1,700 a month home payment, it comes out to $2,779.20 per month available for a new mortgage payment. At a 4.09% interest rate with a 25-year amortization period, his purchasing power comes out to $527,707,000. That's what he qualifies under the current rules. Under the new OSFI rules, that same rental income can't be reused. The new qualifying math is only his salary of $8,500. With his TDSR limit at 44%, the $8,500 times 0.44 comes out to $3,740 a month. Subtract his existing home payment comes out to $2,040 per month. So he now only qualifies for purchasing power of $382,259. Noah's borrowing power drops from $520,707 to $382,259, a $138,448 reduction. That's under the new OSFI rules. So what should you do right now? Step 1, get pre-approved, lock in your qualification under the current framework. Even if you don't buy immediately, it gives you leverage and time. 2, review your income structure, ensure rental income is properly documented and your tax returns are clean. This helps lenders give you a lower risk. 3, ask for a post-2025 simulation. Have your broker or mortgage advisor calculate your borrowing power under the new OSFI guidelines. The difference can be eye-opening. 4, line up the right property. If you've been eyeing a second home or an investment in Calgary's growing neighborhoods, act before the rules do. The 2026 OSFI changes aren't a reason to panic, but they are a reason to plan. The investors and buyers who act early will secure their financing on today's terms. Those who wait may find the door closing just as opportunity knocks. So if you have any questions or want more information regarding this, feel free to reach out, click the links in the bio, book a call today. Thanks for watching.